Hi guys, welcome to Invest with George, where I break down company fundamentals and valuation. Today we're looking at Howard Hughes. Howard Hughes is a very interesting company. It's now a holdings company. It's got a market cap of 4.7 billion and an enterprise value of 8.5 billion. The shares have traded sideways over the years, as its earnings have been quite volatile. So for those that are new to the company, Howard Hughes traditionally or historically was a master plan community developer, which it still is. But the company is now transforming into a holdings company under the control of Pershing Square and Bill Ackman. And I guess the reason Bill Ackman's been involved is because the share price has done nothing for many years, despite kind of earnings being volatile, but the company's still growing and its assets that are growing have gone up in value. The market hasn't really rewarded its net asset value per share. And so we're going to talk about where the company could go, what are the changes that are happening with Bill Ackman's involvement in the company, and I guess what Bill Ackman is trying to do. So Howard Hughes is a master plan community developer. It's a very interesting and kind of unique business where they're developing entire towns and cities. So they're building the property in the area. They buy the land bank, they develop the land, they build the roads, they build infrastructure, and they maintain it. And over time they develop it more and more and more. And the idea is for these areas to become more attractive places to live. So below is some of their best performing communities in terms of land value appreciation. Summerlin, which is in Vegas, and then these two properties which are in Texas. And so the business model really is to develop these areas, sell the land to home builders who want to build in the area because it's becoming a more attractive place to live and demand is likely to increase. And then the existing land that they hold, continue developing in and around it. And so you're building hotels, you're building multifamily apartments, office buildings, retail centres. And what they want to do is they want to sell off some of the land gradually over time, not all in one go, but gradually over time in their different communities. And then they want to hold existing land and existing properties and rent out those properties. Some of the most attractive properties that they have, they'll be renting them out. So they'll have a net operating income on those assets, and then selling the land off and continuing to maintain the area as well. And so the idea is to develop and improve these communities. NAV is expected to increase gradually over time, but cash flows are irregular due to interest rates affecting asset sales. So the asset disposals, obviously they come in different waves and demand depends on where interest rates are. As you can see, this is Howard Hughes' revenue, EBITDA and free cash flow. And you can see over the years it's been quite volatile depending on interest rates and the timing of asset disposals. But the company generates a lot of cash. So they're highly cash generative. And Bill Ackman's kind of been frustrated over the years as he's been involved in the company because the company's free cash flow and its earnings are volatile, and it's hard for Wall Street to put a value on that. Because it's a property developer, its assets should be based on the net asset value of the company. But because the free cash flow is so volatile, which is what Wall Street are following, it's hard for Wall Street to give to put a buy rating or a recommendation on Howard Hughes as it's a company that has volatile earnings, which is what the sell side analysts are using to value companies. So it might not be a great business for Wall Street to be publicly listed. And so this is why Bill Ackman's got involved in the company. So this is the transaction that was done in May. So Pershing Square bought 9 newly issued shares in the holdings company. So they spent 900 million investing in the company. He's purchased these shares at a 48% premium. So they paid more than what the shares are actually trading at. Obviously they were newly issued shares, but he's buying in at a premium to kind of demonstrate to the market that as a big investor, he's now a 47% investor, voting power is capped as well at 40%. But that he believes in the company, and he's putting even though he's taking fees, he is a huge investor in the company and believes in the company. And he's kind of said to investors, I've never planned on selling my shares, and this is like a long-term strategy that we're going to employ. So we're going to transform Howard Hughes Holdings, well, it's the property developer. The property developer is now going to sit underneath the company as a subsidiary, and we are going to turn the company into a diversified holdings company, buying stakes in high quality, durable growth companies while continuing to invest in the real estate business. And so Bill Ackman joins the board as the executive chairman, and Ryan Israel, the CIO of Pershing Square, is joining in the same role at Howard Hughes. So Pershing Square is a major investor in the company. However, they're mainly stepping in and getting fees to provide investment expertise. In return, Howard Hughes Holdings is going to pay Pershing Square a fixed management fee every quarter of 3.75 million, which is 15 million a year as a fixed fee. They're also going to get a variable fee of 0.375%, which is 1.5% annually. On the market capitalization above a certain threshold, which we'll look at later on. So all of this information is from the Howard Hughes AGM this year, so you can go and watch that in your own time. It's a few hours long, but all these slides are from that AGM. What's really key to this thesis is Bill Ackman. What he wants to do is essentially kind of create a Berkshire 2.0, but with management fees. So what he wants to do is go and buy a P&C insurer, property and casualty insurer, and improve the investment returns, because obviously with insurance companies you have your underwriting, which is your core sort of business. The other side of the business is also you have an investment portfolio, or the free float of your insurance company, and utilizing that money to get a return. And typically it's a very safe investment. Most of the assets are going towards fixed income assets. But what Bill Ackman wants to do is he wants to increase the performance of the portfolio within these insurance companies, or with their free float. And the reason why he thinks he can do that is because of this key point here. It's the fact that insurance companies find it difficult to find the best-in-class investment talent. So the reason for that is compensation, because if you're a good portfolio manager, you'll work in private equity, or you might work in a hedge fund or an asset management firm. You're not going to go work in an insurance company, because the pay is going to be so much better as an investment individual within asset management generally. You're not going to go work for an insurance. So partly the reason why investment performance is low in insurance companies, or I guess suboptimized or underutilized, is because they don't have the talent, and also they don't have the structure. And the reason for that is also because when you're a public insurance company, Wall Street wants stability in earnings, and they want the earnings to be visible, and for the sell side to have a degree of conviction in what they're modeling, so they can advise the buy side with what the company's EPS can be in a year's time, 2 years time, 3 years time, and discount the cash flows back. And with an insurance company, having fixed income in your portfolio as a main way to generate return on equity and generate free cash flow, that fixed income is relatively predictable. So roughly what yield you're going to earn from those fixed income instruments. Whereas if you're investing in common stocks, that increases the volatility of the performance of the portfolio, or the returns that you're getting from the portfolio, which means that insurance companies stay away from this. So not only can they not get the best talent, but also it doesn't suit the structure of the company and the structure of how you communicate and engage with capital markets. The reason why this is relevant is because, if I haven't said it already, Howard Hughes is planning on buying an insurance company and utilizing the free float, or the cash of the insurance company, to invest in equities as an aggressive growth strategy, rather than buying in mostly fixed income instruments, which is essentially what Berkshire Hathaway done very successfully over many decades. So this is the traditional asset allocation of a insurance company, a P&C insurance company, where you have very low exposure to equity strategies or equity type strategies. So you've got fixed income, which is mostly investment grade. It's also got some preferred stock, which pays a fixed dividend on the equity. But mostly it would be government issued or investment grade securities, and then short term investments, which are just 3 months or less, or 6 months or less, fixed income. And then you've got other investments and alternatives, which is mostly private equity, private credit, hedge funds, and equities as well. So these two are the more higher return assets in the portfolio, but you can see a huge amount of it goes towards fixed income, which is relatively safe. However, it's very low return. But like I said, with an insurance company that is public and you want to communicate earnings guidance for the next year, having fixed income allows you to report and to basically perform in line with what the market is expecting. So Howard Hughes plans on buying an insurance company and having the insurance company having a higher percentage of their portfolio exposed to equity strategies, so roughly 60%, and then the remaining 40% being in short-term investments. So this is Pershing Square's investment track record. Since inception, they've done 22% a year, or 21.5% a year. That's just the gross fees, so net fees it's around 16%. That's a very, very high return over 2 decades. This isn't just over 5 years. This is consistently over multiple decades, and slightly different markets as well, but mostly exposure to US equities. And since permanent capital era, which is when he stopped shorting companies, and in the last 5 years, those returns are much higher. It can be argued that we could categorise Pershing Square and Bill Ackman as the best investors, or best-in-class investors of their generation. And you can see here from the divergence from the S&P 500 compared to what Pershing Square's funds have done. The return difference is absolutely massive. And I guess this is stayed even with the underperformance that Bill Ackman has had. This return would be even higher without the mistakes he made in the 2010s. The Valiant Pharmaceuticals, I think they lost 4 billion. Herbalife, the battle they had with Carl Icahn. So without those mistakes, these returns would have been even more impressive. And Bill Ackman now calls it his permanent capital era, where essentially he's buying companies that are just going to compound longer term and going to grow and have defensible moats. So this table illustrates return on equity for insurance companies. A typical P&C insurer will be generating a 5% underwriting margin. So 95% will be the percentage of, the combined ratio essentially is the percentage of earned premium that has been paid out in claims. So 5% would be your underwriting margin after taxes. You're generating a roughly 4% return on your equity. And for an average insurance company based on the investment portfolio, mostly fixed income, accounting for the different portfolio allocation and the returns of those assets, you're getting an 8.3% return on equity, totaling a 12.2% return on equity. Berkshire Hathaway, which has had very good investment performance, has had an underwriting return on equity of 1.8%, which isn't very high, but because of its common stock returns of 12.5%, obviously the allocation has been 70% over time. These are probably averages. And the total return on equity was 15% from both the investment portfolio and the underwriting operations. And then this is what Bill Ackman is targeting. So he's saying, I want to buy an insurance company that can write at a combined ratio of 94%, 6% underwriting margin. The underwriting margin after tax is going to be 4.7%, 2.4% underwriting return on equity. And then Bill Ackman wants to have a 60% allocation towards common stocks in the insurance company's investment portfolio, no fixed income and short-term and cash investments. And he thinks this is what he's targeting, a 20% annual return on common stocks. So very, very high, higher than Berkshire, which will generate a 17.7% investment return on equity. Combining the underwriting and the investment performance, the return on equity would be 20%. Generally, for a company that's generating a return on equity of 20% every single year, that would be a very, very profitable company and a growing company. The question is, what returns can Bill Ackman realistically get? He got these 20% returns over 2 decades, but a big part of that was the bull market after 2020. Realistically, maybe this is probably the region that we're looking at. So this is investment in common stocks. The higher it is, the higher the return on equity. Combined ratio, the higher it is, the lower the return on equity. So you want a combined ratio that is lower. So realistically, at 94% combined ratio, targeting 12 to 20%, you're probably looking at this as a return on equity. It's somewhere in this sort of region, so the mid to high teens. And if Bill Ackman do that, I think he justifies the fees that he's going to charge. And I think the company could be a long-term compounder. So what are the actual fees to Pershing Square? I wrote an article on Seeking Alpha where I broke down the fees for Pershing Square. And a fund manager reached out to me and said, you've got this wrong because you didn't take account for inflation. So this is his table. So the agreement and transaction between Pershing Square and Howard Hughes Holdings happened in May of this year. At the time of transaction, there was 220 days left in the year. If we say the share price is $80 a share, that's roughly a 21% increase in price. That means the market cap would be 4.7 billion. And the reference market cap, which is based on this share count here, would be 3.9 million. The increase in market cap is 822 million, but we first need to correct the market cap for inflation. So we need to increase this market cap so it reflects 2.5% inflation every year. Obviously, it depends on what inflation is. That would give a market cap of 3.98 billion. So if we take the current market cap under this assumption and we subtract the corrected market cap, we get an increase in market cap of 763 million. And the management fee is 1.5% on that, which is roughly $11.5 million. Including the annual base fee of $50 million, the total management fee as a percentage of the entire market cap is 0.56%. So as the company's share price goes up and its market cap goes up, so do the fees to Pershing Square and Bill Ackman. So at 11 or 10 billion, there's roughly over 100 million in fees is going to Pershing Square annually. So if you're comparing this to a normal hedge fund or having access to a normal portfolio manager like Bill Ackman, his fees typically will be 2 and 20, where they're charging a 2% management fee or 1.5% management fee, and then they're taking 20% of the profits above 8%. So you're paying 2% every single year or 1.5% every single year on your investment portfolio, and then you're also going to be paying 20% to the portfolio manager for anything above 8%. So if you earn, a 10% return, of that 2% extra that you're getting above 8%, 20% of that profit goes towards the portfolio manager in the form of carried interest. However, this structure is different and the way it can affect the company's free cash flow is more important. So investors while they're looking at the management fee, they also need to consider it depends on how fast Bill Ackman can increase the value of the company. And I guess a concern is what happens if the company stagnates for more years, where he's taking still $60 million or $80 million and the share price is stagnating. That is the key worry for investors. So just to remember, Bill Ackman and Pershing Square have invested a lot of capital into the company. And so while they're charging fees, they're really charging fees on a company that they own shares in, where they're a 47% shareholder in. So while they're collecting fees, they're also a beneficiary of the company's long-term performance. So Bill Ackman has communicated that they are looking at an insurance company and are probably going to announce the target company or the acquisition probably early in 2026. I hope that makes it easier to understand Howard Hughes and what Bill Ackman and Pershing Square are trying to do. Always do your own research, and I'll see you guys in the next video.